in which Netflix is buying Warner's streaming and movie studio business. Our guest says this deal could get a bit messy. We're joined by Brian Belski, CEO and Chief Investment Officer at Humulus Investment Strategies. Brian, thanks very much indeed for joining us. Happy Friday. Everybody knows about movies and streaming, and so the regulators may have an objection to Netflix getting so much power, do you think?
There might be. Good morning, Canada. There might be. Paramount wanted this content for a number of different reasons, so there could be some issues there. I would also think, too, that this follows through with what our broader theme for the communication services sector has been for 10 years, which is the 3 C's, which would be cash, content, and consolidation. Mm-hmm. We think there's more coming. We think this is all about buying the brand of Warner Brothers and really their great HBO brand and some of their other series, whether or not that's Batman and those types of things, and maybe Netflix can monetize it a little bit better than Warner Brothers has when this spin out. Remember, this company was spun out from AT&T. Mm-hmm. So I think that there's going to be probably some noise around this. Paramount wanted the whole thing, and so there could be some disruption. But at the end of the day, we're happy because we own Warner Brothers. And we also own Netflix, but I think the Netflix part of it, I don't care if the stock is down today. We don't manage money for a day. We think from the longer term perspective, the trend of accumulating this type of great content makes a lot of sense for Netflix.
The stock's slipping a bit, but as you say, just one day. Maybe we could put up a 5 or a 10-year chart for Netflix because they just seem to go from strength to strength, a global franchise, to put it mildly.
Well, you and I are probably old enough to remember the late 1970s, and I like to explain how important HBO was in the late 1970s, early 80s. I mean, that was the channel to have. That's what they had, the content. They had movies faster. Mm-hmm. Remember, cable was a big deal. And if you also remember, too, stand-up comedy really was born in terms of the new age with respect to television in the late 70s, early 80s on HBO. So now you fast forward a couple, 3 decades, and Netflix now is the place for stand-up comedy and the like. So there is some correlations there that I think are very, very interesting. Mm-hmm. And I do think as you look at these other studios, whether or not it's Sony or Amazon and even Paramount, Comcast is probably in play in terms of part of what they're doing. Remember, the streaming companies, these big companies with streaming services, really difficult to monetize. Apple's done a pretty good job. Netflix has done a pretty good job. Disney's done a pretty good job. But aside from that, it's a tough sled. And that's why you saw the Paramount Skydance merger. Mm-hmm. And so I think there's more coming. And on this particular buyout here of Netflix, I think it could be noisy.
You could be noisy in terms of anti-monopoly concerns, Brian?
I don't think it's so much that. I think the media is making too much play out of President Trump and the administration with respect to the conservative ties of Paramount and Mr. Ellison at Oracle. I think that's not. I think that's the anti part of that is not a big part of it. I think there's going to be some other companies coming in. Mm-hmm. I think that there could be this could spur other mergers and activity. The good thing about this particular consolidation, and from our lenses, we like the fact that they're using cash. We like consolidation with cash. If it was the majority of stock, we wouldn't like it, but we like the notion of companies being bought with a majority of cash.
Brian, what else? We're seeing more and more speculation that the AI business is a bubble, or at least the valuations on these stocks. And apparently some evidence is emerging that companies are having a tough time initially getting much more productivity out of AI tools.
I think it's early on. I love the speculation with respect to AI. I think you need these bearish prognostications out there. I think the CapEx boom is just beginning. But what we're seeing is delineation and dispersion within companies, which has been our broader theme with respect to our investment strategy for several years. So we're seeing things in performance with respect to not only fundamentals, but price performance, Andrew, spread out. And that's very, very good. So the market in AI and slash tech has been excessively what I would call resilient with respect to some of the pullback that we saw in November heading into December. Part of that might be kind of just end of the month profit taking in November. But now, if you take a look at the majority of institutional accounts and hedge funds, they're massively underperforming. And so I do think once we start to have kind of a settling in here, which we already have here the first week of December, I think we could have a very strong couple of weeks. We don't like to make short-term calls with respect to running money or our investment strategy, but I think we could have a couple very strong weeks heading into the Christmas season where portfolios will be lifted higher, especially given the fact that, again, a lot of these institutional accounts are underperforming.
That's institutions have underperformed partly because they weren't riding these big tech names higher?
Yes, that is correct. They were late, or they picked the wrong tech names, and they've been focusing more on the negativity, and they got too short and sold too soon. So again, we're not short-term investors, we're longer-term investors. We take 18 to 24 months minimum when we take a look at a company. And so that's we've been very blessed and fortunate to have great performance in our portfolios because of that, because we stick with our process and our discipline.
Brian, thank you very much indeed.
Thank you.
Brian Belski, CEO and Chief Investment Officer at Humulus